Good morning and welcome to Rehacking Live. Um, Chris, you might be wondering where he is right now. He is actually in the middle of a eviction online, so he should hop in here soon. So thank you for joining Rehacking Live. Today we're going to be speaking with some of the top real estate professionals in the industry. And today's topic is going to be, how will the real estate market be in 2022? Oh, there you are. Did we win the eviction?
Yeah. It took 50 minutes to hear me and 3.5 minutes to settle the case.
Oh, all right.
So,
well, good news.
Glad I could join everyone.
I know, and it's the holiday season too. But it's business.
Yeah, no, I mean, so obviously, yeah, I just want to touch on this before we get started. That is definitely a concern, and we've been extremely fair with all the tenants. Like, they just absolutely 100% stopped communicating. Like, if it was,
Right.
hey, we're communicating, and we've had people with COVID issues, and actually they got behind. We'll let them catch up. But with no communication, it's kind of hard to work with you. Sorry.
Right. So yeah.
All right.
But anyway, welcome. So this morning we're just going to be talking about maybe projections and kind of the forecast of 2022 with a bunch of different great guests. So let's go ahead.
Our first guest.
Yes, we'll start with Steve Baker. Hi, good morning.
Hello, how are you?
Doing good. How are you doing, Steve?
Great. Thanks for having me.
Thanks so much for joining us. Okay, let me see. I have this teeny tiny laptop, and Chris was like, you gotta run it. I'm like, it's so slow, and I just want to throw it out the window,
Yeah, last minute audible, Tom Brady style.
Right. All right. So just a little bit about Steve. Steve is a loan officer in Houston, Texas with Movement Mortgage. He is a 25-year veteran in the mortgage industry. So thank you so much for joining us.
Great. Thank you. You're welcome.
Thank you, Steve. I've really enjoyed your newsletter. I'm weird about email. I absolutely hate them, but I don't unsubscribe from good ones, even though I hate email. And yours has been good because it's value add. And you actually provide a lot of really good nuggets on market updates. So whenever I thought of this topic, I was like, hey, I definitely got to have Steve on.
Sure.
So appreciate that. What do you think? What is 22 going to look like for real estate? Uh-oh, may have some lag here. Are you there, Steve? One of the problems for live shows, technology issues. This would be equivalent to, I guess, a mic, unless it's my side. I guess the mic going down live stage.
No, yeah, he's frozen on my side too. We can pull up Jason really quick. I see him in the background.
Okay. All right, yeah, let's do that.
Back up. Okay.
All right, Steve, we'll bring you up in here in a minute. I'm gonna pull Jason up.
Hi,
Another
Jason.
audible.
I did a webinar last night, and literally there's like 9 people on the panel, and I'm talking, and all of a sudden everyone like freezes, and I was like, uh-oh, and then boom, goes down. Anyway.
Yeah.
Hopefully you hear me here at the hub for real estate investing in Texas, the Texas Real Estate Investment Center.
Yes, thank you for joining us and being flexible with us today. So for those of the audience who don't know Mr. Jason Bible, let me just give a little background. Jason is a Houston, Texan native. He's the founder of Texas Real Estate Radio Network and Chief Information Officer at Mr. Texas Real Estate. Through his companies, plural, he has many. We were discussing it before the show. He has invested in hundreds of single family and multifamily properties. So welcome. Thanks so much for joining us. Always great to have a chat with you.
Yeah, thanks for having me on the show today, guys.
Absolutely. Thanks for joining us. I know you're a data guy, and you love talking about markets. So 2022, what is the real estate market going to look like?
Well, I'll tell you, everyone laughed in October 2017 when I said, if you think real estate's expensive now, just wait. And now nobody's laughing.
Well,
And
that's
we
because a crash has been coming every year since like 2015, 2017, right?
Bro, I will tell you, you want to have some fun? Go to YouTube, type in any year you want and real estate crash, and there'll be hundreds of videos from gurus and economists saying that the world is going to end and there's this huge crash coming. And the reality is that's just not the case. So we do a big event in February where I let everybody do their predictions in January, and then we host a really big event in February where I give like the real market data and the analysis of what's going to happen in 22. But I'll give you a preview to that show. We're going to have another year of double-digit appreciation, probably 20%. Rates are not going up. Everybody keeps talking about rates going up. They ain't going up. So the old adage is when inflation is high, we can increase rates. Yeah, we could do that in the late 70s, early 80s. We can't do that now. And there's some reasons why. When you increase rates, you pull liquidity out of the marketplace. That's what's causing inflation.
Correct.
All these extra dollars out there bring money back in. Well, back in the 70s, there was no China. Japan wasn't even that big of a factor until the mid to late 80s. So now we have these international markets that they can play the currency game just like we can. So increasing interest rates is not going to pull liquidity off the market. It's just going to import inflation from other countries. So the reality is that we have really no tools to fight inflation, but for one, and that is a recession. So I don't think when people are predicting increases in rates and all that, it's not going to happen. It's just
by
not.
Increases, are you thinking like none or nothing substantive?
I could say 50% chance we will actually see a decrease in rates, and then there's a 50% chance we're looking at a quarter point bump, maybe half.
So either way, it's not changing too much.
It's nothing.
And so you actually said something, and I think this happened in, I guess it was the 70s or 80s, and not that I lived through it, but I've read it, and my grandfather talked about this, was when they did try to increase rates to pull back the market, and they actually caused an inverse reaction of fear of loss. Everyone fearing that they're going to miss out, and which if that were to happen here, that's a very real scenario where, oh crap, like I better pay the 3.5% because I don't want to pay 4.5% by waiting next year, which causes home prices to go up even further. Is maybe that part of your calculus on if prices did go up? Now you're going to continue to see those, the appreciation like we've seen over the last 18 months.
You are 100% right. That is exactly what's going to happen. It's called a melt up. So what's going to happen is let's play the scenario as if that's going to happen. Rates will go up if you believe that to be true. There will be a run on hard commodities like real estate, like you would not believe. You think it's inflation's crazy now? Wait till people think there's going to be 5, 7, 8, 9, 10% rates on houses. You will see people jump in just to beat the next rate hike. I don't think that's going to happen, but in other words, I don't think the interest rates are going to happen. But what you have said is absolutely 100% correct.
Yeah, that can't really influence the refinance market. I mean, pretty much anyone that could refinance, they've already done that if they could or had the desire to. So the only one the only group of people that are enjoying or can enjoy low rates right now are people who are buying, and that has been due to supply issues and other things. That's been low as far as those kind of transactions. But hey, let me know your thoughts on this. I was reading a report recently, I think it was by Redfin, that so Texas, Sun Belt area, it's been hot for a long time. It's been like absolutely red hot over the last 18 months. They predicted a slowdown in growth. And by slowdown, it's relative, but a slowdown in growth for those markets. And we're actually going to start seeing similar, what's been going with the Sun Belt going into some of the Midwest, Ohio, Tennessee, some of those states, because of, now, Tampa, Miami, Florida, you get outpriced there. Well, where do you go next? So what are your thoughts there?
Our biggest challenge is home prices rising too fast. That's the real, it's funny, everyone's talking about a real estate crash. And 2 years ago I said, and especially right before COVID, I said, we are in a real estate crash on the supply side. Like inventory has collapsed. You're right. We are in the middle of a crash. It's called supply. Everyone forgets there's demand and supply curve. The supply
There's two
crash.
sides.
Demand has actually gone up a little bit, but even if it stayed the same, prices are still going to go through the roof.
Yeah,
So,
we're like what, 4 million houses shy?
yeah, the last report said 5 million houses. And at the time, it was crazy. There were 5 million houses short, and there were 4 million houses in forbearance. And this is when all the guys were saying, like, hey, when all these houses go to foreclosure, there's going to be a real estate crash. I'm like, bro, we're still 1 million houses short nationally. Like,
I've been saying that too. It's like, yeah. Anyway.
So to kind of go back to your point, I think the bigger problem is we have a huge affordable housing problem. So Jamie and I were chatting before the show started, and I know you guys are buying a bunch of rentals. So last week, you guys are in the kind of same business we are. So last week I was goofing around on MLS, and I looked at how many houses, how many months of inventory in the last 30 days that we have of houses below $200,000. You want to guess how many months of inventory we have on the marketplace?
Very, 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 very little. I mean, that market is almost extinct.
It's 3 weeks. A normal market is 6 months. We have 3 weeks below $200,000.
And that house is either it's in a horrible area or it's burnt down, and it's now still priced. I mean, these are houses that 5 years ago you'd pay 70 grand for. It's just,
that's right.
Now they're 165 and getting multiple offers. We'll tie up with this question. What do you think, or what should investors be focused on, planning for 2022 and even going further? There's a lot of exit strategies. I know Airbnb is really hot. Multifamily seems to, there's a lot more chatter about multifamily amongst people who used to flip and wholesale, me included. Then you still have your flipping and wholesalers. What should investors, let's say new investors or newer investors?
I think there's only one strategy. By the way, I don't believe the Airbnb boom, by the way. I think there's a lot of people who talk a lot about Airbnb, but who've not been doing this long enough to really understand the numbers. Like they brag during the summer, but then in the winter months, they get real quiet on Facebook.
Yeah. Our lake house doesn't have a lot of December bookings right now. So
yeah. You know what? It's funny. I did the QuestCon, the Quest thing, and there was a gal that did Airbnb there, and her and I talked, and I could tell people who have been in this business for a while and who haven't, and her and I compared notes, and she's in North Carolina, and we had the exact same experience. She's like, yeah, this is how it works. And anyway, so I don't believe the Airbnb stuff, but no, don't get me wrong, we have like 50 of them, but it's a lot different than what people put on Facebook, and put that.
Yep.
What should new investors do? Real simple, buy everything at cash flows. And if you're waiting, like I'm waiting for something to happen, I'm waiting to learn this market, just keep in mind that houses in Houston, Texas, on average, in the median, are appreciating $4,000 a month. So every month you wait, it's costing you $4,000 more to buy that rental property.
Not to mention whatever money you have in that savings account waiting is worth less and less.
It's worth 0.5% to 1% less. Yeah. So the reality is, if you're one of these people that are waiting, just turn all the real estate stuff off, because you're really not serious about being in this business. Yeah. You're either in right now or it's over. The real estate slowdown that's going to happen in 2025 or 2028. Let's go back to your 70s analogy. When inflation essentially got under control in the 80s, the prices didn't go back to 1970. Like, this is what a lot of people miss. There was 10, 15, 20, 25% inflation for almost a decade. In fact, your money
down to it, you don't really lose money unless you sell. By and large, I mean, there's nuances to it, especially with the cash.
Let me make the point for you here. The cash was worth half by the end of the decade. Your money was literally worth half by the end of the decade. But the prices on real assets never went down. Like, that's, I think, the part people miss. Oh, if I bought a house in 1978 or 1982 when rates were 18%, it was worth less than when inflation got under control 4 years later. That's not true. What happened is the rate, literally inflation was doing this, and then it just started to flatten out a little bit.
Yeah.
And prices followed right along. They never went back. So if people are waiting for this big crash, this big reset, it's not going to happen.
So many people are still traumatized by 2008, understandably so. So how can folks reach out to you?
mrtxre.com. or shoot me an email, jason@mrtxre.com, and that's it.
Sounds good.
Great.
All
Thank
right.
you so much for
Look forward
for
to seeing
joining
you.
us.
Yeah, absolutely. Thanks for having me on the show, guys.
I know these
Absolutely.
10 minutes go by really fast.
They do.
All right, take care.
We'll bring Steve back up. Well, now I don't see him at his desk, but he was
All
right
right.
there. I could have kept Jason on for a minute longer, but I know that Steve
Great.
has
Let's bring him up. He may be in earshot. Hey, Steve, are you there? This is a live show. We make mistakes. Sometimes embarrass ourselves, but
Speak for
there's
yourself.
always live, good live content in the mix. So
I was trying to get Jason off because I knew I had Steve has a lunch to get to. So
okay, we're gonna move over to Ray.
yes.
What's up, guys?
Good
Hey, what's
morning,
going on,
Ray.
Ray?
And
Good, good.
I know I just texted you. We're just going with the flow here this morning. It's been a rough start this morning. So
No worries. I got
thank you so much.
flexibility.
Thanks so much for joining us. A little bit about Ray. Ray is the director of strategic accounts and Kiavi, formerly known as Lending Home. He provides financing, data mining, and technology resources to help real estate investors make better business decisions. So thank you so much for joining us this morning.
My pleasure. I couldn't have said that any better.
Good seeing you, Ray. It's been a
Yeah.
while.
It has been a while since I was in your office many, many years ago.
Yeah. So, glad we can chat. I always love asking this question to lenders or folks that work in the mortgage space, specifically in your case, working with investors, because
Right.
that's your company's niche, because you've got a good pulse on the market. You're talking with a lot of different operators in different markets doing different things. So with your pulse on the market, what are you thinking real estate's going to look like in 2022?
I think it's going to look a lot like what it did in 2021, but better. I think, you were on just before with Jason and talking about the inventory problem that won't get cured in 2022. So, I spend, as someone in business development, all I want to do is listen to what customers are experiencing so that we're kind of out in front of, issues. And so as 2021 went into this year, we're going to 2022 here in less than a month. I think there's a better playbook for folks as it relates to properties that they're taking down. There's a higher level of confidence as it relates to exits. I think interest rates, at least on the consumer side, will continue to be at bay. There's always I think a little bit of force on interest rates to go up, but I truly believe, both myself and what I hear on the consumer side, right? This is not on the business purpose side, investment side, et cetera, that those interest rates will, for the most part, stay at levels that they're currently at. And that's a lot of it's going to be driven by the fact that, employment and income are not keeping pace. Right. It's not like all of a sudden people are making 50K more per year these days. Inventory isn't being cured. And as you see almost every single time that interest rates start to ratchet up a bit, there's like a fury, right, from a consumer standpoint. And then all of a sudden they dip back down. So I think from a confidence standpoint, that's going to stay about the same. We have 4 kids and 3 of them are probably in that possible home buying mode here in the next year or so. It would be interesting to see how conventional mortgage lenders start to expand the box once refinances start to dissipate, right? And so, will a 40-year AM or a 50-year AM come around sometime next year versus going down the path of maybe credit softening? Because you had mentioned, 06, 07, 08, which I was in the mortgage industry at that time. And that's what took place, right? That's what caused much of that credit crash. Whereas if the amortizations just went out and the rigor that already exists today on the conventional side stays the same, I think that's potentially a way of being able to address more homeowners as prices start to continue to tick up. But I think 2022, both as Kiavi funding provides residential financing for both short-term and long-term financing. We feel that market's going to be extremely strong, with maybe a possibility of interest rate pressure toward the end of the year. But we're not hearing a lot of that pressure being in Q1, 2, or 3.
Yeah, I mean, everything I've heard is if we see anything, it'll be 1 or 2 rate hikes, which is which will be minimal. But it's almost like it's a very complex problem. We have all these issues with supply being one of the major problems of it. You mentioned the delta, the difference now between rate of growth of home prices and of wages. The one thing that's helped that is just historically low interest rates.
Right.
But as that ticks up, every quarter point, half a point, eighth a point, or whatever, that eats into that affordability that's already a problem. So yeah, if it does go up, it creates an affordability, it expounds the affordability problem that we already have.
Correct.
I'm not really sure what that looks like, but for investors, because you deal with not necessarily, I don't know if coaching is the right word, but definitely providing strategic advice for investors, especially in relation to the products that you offer.
Right.
What conversations are you having with investors out there that are they're actively acquiring deals?
That's a good question. So what I try to pass along is I speak almost exclusively, not 100%, but almost exclusively with a lot of experienced operators, right? Folks that are earnestly, investing in real estate, whether they're keeping rentals, whether they're doing flips, whether they're doing both, et cetera. And the constant feedback that they share with me, that I share with newer investors, is kind of know your numbers and stick to them, right? So don't go chasing these increases in prices and think that you can sort of make up for it on the back, because that ends up, if you're a newer investor, you just don't have the staying power. You probably don't have the capital to really overcome 1 or maybe 2 of those purchasing mistakes.
Which is hard to do in a low supply market.
It is.
Because
it is.
stretching, we found ourselves doing that in 2019. And it's part of the reason why we just switched to buy and hold. It's just so much simpler when you hold it long term.
Yeah, and I'm seeing more of a shift in that, and it's a decision operators have to make, because the short term money's still there, right? So if you sell these properties, you could still make money, but I think people are looking at it from more of a strategic lens versus a monetary lens, right? An instant monetary lens. And so, yes, you could take 20, 30, 40K currently right now if you sell, and you're going to get buyers, but what is your long-term play? And so there's a couple of, certainly if you're a newer investor, I think you have to make money. And so a lot of times it's done through an exit through sale, but I'm noticing, I think, people accelerating their adding rentals to their business plan sooner than later. And most of it's just because they feel that the acquisition prices are getting out of hand, and they need to accelerate that by keeping these properties. You can always sell. And I agree with what you said with Jason, that we're not anticipating a massive value crash, right? Like we once had. I think inventory has to almost overcorrect, and it's not even coming close to correcting.
Yeah, that's going to take time.
Yep.
Yeah. Okay. How can folks reach out to you and your company?
Well, the easiest way is my email is ray@kiavi, spelled KIAVI.com. So that was one of the benefits of our rebrand, is our my email address got shorter. But that way I can kind of correspond with them. I can connect them maybe with the right team member if they actually have some properties that they need to finance, et cetera. But from an education standpoint, it's always better to start with the folks in new business like myself.
Yeah, and I've always had a great relationship. I don't think I've ever worked with you on short term, but I've done long term several times. And I think we actually just sold the most recent one. So had a great experience. Yeah, definitely
appreciate it.
So thanks for being on.
Okay, thanks for having me, guys.
Absolutely. Take care.
Have a good day.
Okay. All right. Great stuff. Next, we have, why don't you pull up Richard Drake? Hi, Richard.
What's up, guys? How
All
you
right.
doing?
You.
Doing good. Yeah.
Thanks so much
Oh,
for
not
joining
bad.
us this morning.
Well, you guys finished a little early there, and I'm not usually early. So
Oh, yeah.
I
I
know
mean,
it said 20 minutes early, and I was 10 minutes early. So I was like,
well, thank you. Because we lost one guest earlier. I mean, we've had a couple of hiccups this
I
morning,
got
but
you.
now
It
we're
happens.
getting back on track. So perfect. But thanks for joining us. Those of you in our audience who don't know who Richard Drake is, let me just give a little background. Richard is a former naval officer and the CEO of Renters Warehouse Houston, which is the most successful renters warehouse franchise in the nation. He is also owner of the oldest Homevestors franchise and has flipped over 1,500 houses. So thank you so much for joining us.
Man,
Well,
you've got
appreciate
no, I was reading your bio. I knew you were a Homevestors guy. Definitely know your success with the Renters Warehouse. Y'all kind of came out of nowhere, at least from my observation. And then now you're like this behemoth, one of the best ones in the entire nation, right? Like you've set a lot of
we're doing.
new records.
Yeah, we're doing a lot of business.
So from both an investor standpoint and also the services standpoint with your property management company, you definitely have a very strong pulse on the market, active, and then just operationally. What are you seeing the real estate market looking like in 2022?
Well, I'll echo what Ray just got through saying. I don't think there's much of a chance in the next decade or longer that we can catch up with a supply shortage. The regulatory environment right now is so tough, and it's not going to get any better, right? It's just going to get
You're thinking
more strict, more overreaching, right?
So you're thinking we may have a decade of that?
Well, here's what I'll say. I'm not necessarily saying that we're going to see 20% appreciation every year, right? That's not normal and goes crazy. And
Eventually, you hit that affordability problem.
Correct. So what'll happen?
Yeah.
Exactly. However, the demand for housing is outpacing the delivery of new properties every year, and has for years and decades already. So the fact that development is more difficult, more regulations, environmental this, drainage that, cost here, cost there. No one wants to build, for instance, a C-class apartment. They're not going to do it. It's not affordable. It's not, you can't build a C-class apartment from the ground up and make money.
Yeah.
You have to build A-class, right? So there's a huge opportunity, I think, in there where people are buying and holding these older apartments that they can make a significant return, because that inventory is in higher and higher demand because of the affordability of single families. Even more demand for the apartment, right? Higher and higher demand, and the inventory is going down because they're eventually getting demolished or converted to something else or what have you. And it's a perfect storm for that little niche. The second part is the same, 250 and below houses. I don't see any scenario where they don't appreciate significantly for 10 years plus.
That's why I had an eviction before the show, and this is one where we've already done an eviction on that house before, but it's in the path of progress. But when you look at the math, I was telling Jamie, it's like every year, just from our single family rentals, excluding the multifamily, we gain $100,000 in equity a year based on a normal scenario, not COVID crazy appreciation scenarios. It just makes it so hard for landlords to want to give that up, because what's my opportunity cost? I'm gonna go ahead and
it's an interesting time. I did an interview for Homevestors Corporate because they have their 25th anniversary, right? And one of the things they said was, if you could go back and be yourself on day one of being an investor, what would you do? And it was the easiest answer I've ever had: hold as much as I could.
Yeah.
Because if I look back at all those houses that I flipped, right, hundreds and hundreds of houses that I sold for 150 that are $600,000 or $700,000
Like
houses today.
$50 a square foot, $60 a square foot.
And I thought I was killing it. For instance, everybody knows South Park, right? I would buy houses over there for 7,000, 10,000, 12,000, and sell them for 59.9, and people thought we were ripping people off at 59.9.
Yeah.
Oh, it's too high. I can't believe you're selling for that much. 59.9. You can't even buy a wholesale deal for 75, 80 grand anymore over there.
Yeah.
Right.
Yeah. That's what the lots go for now.
And I still hold a lot of property over there because they do great. But if I looked at, when you sell a house, you create current income, ordinary income. Because a lot of people say, well, selling real estate is capital gains. Not if it's your business.
Mm-hmm.
If it's your business, that's your business. If you're a real estate professional, it's ordinary income to you.
Mm-hmm.
So you sell a house, you create ordinary income. If you hold a house and you rent it, you lose money, right, on paper.
Mm-hmm.
And if you can sell just enough to survive and do this while you're young or younger, because that's not me, heck, you look up and you got generational wealth that you built.
So yeah, that's a very, very good point there. So Jamie and I started realizing that, like, hey, we're making 20, 30, 40 on these flips, but these little rentals that we held for a few years, like every time we sold one, we made 100, 120. So and tax situation is different. It's not ordinary income. It's long-term capital gains, which there are ways to even defer that. But we call it the slow flip strategy. If you want to flip houses, just do it over a 3, 5, 7 year timeline. And then if you can get enough in that hopper to feed yourself, you got to feed yourself in the meantime, whether it's a W-2 job or you're doing, you're flipping a couple, holding one, flipping a couple, holding one. And then in 5 years, you just want to sell off the worst one, the biggest headache. You got $100, you got 100 grand payday, 120 grand payday, 150 grand payday. And then if you really want to accelerate it, you take that 150 grand and you don't use it to go buy a Range Rover, and you go out and buy 3 more properties.
Yep.
Man.
Well, I saw a pretty neat deal. This guy was talking about this thing called 15 and 15. Have you ever heard that phrase?
No.
So what you do is you buy 15 houses over 15 years, and you could do 1 a year, or you could do 10 a year, right? But let's just use the example of 1 a year. You buy a house every year, you rent it out, you put it on a 15-year AM, and at the end of the 15th year, now you have 15 houses, right? And 1 house pays off, right? Now, you're not going to make any dang money off of these things with a 15-year AM, right? You're just not. You're not going to make a whole lot of cash flow because the accelerated payback. But if you look at that, if you can do that in some multiple of this, let's say they're $150,000 houses. Well, in 15 years, how much is that $150,000 house worth? Let's call it 300. Now, at the end of 15 years, you don't sell that house. You refi it. You get $240,000 out, or 200,000, let's say. Let's just be conservative. You only get 60% LTV. You get 200 out per house. Let's say you did 5 a year, so that'd be $1 million, right? If you did 5, and that's not income.
Yeah,
that's debt. It's debt.
Free.
Now every year you get $1 million. If you did 5 a year for 15 years, you get $1 million a year in new debt, but not income every year.
Tax free.
Maybe you did 5 a year, and now you're only going to refi 3 of them or 4 of them, and you just cash flow the other 2, right?
Yeah.
But the other part of that, over these years, all you've done is depreciate them and lose money on paper. So you've never paid income tax on all these years. And 15 years down the road, you have all of these houses where you could either let them all pay off if you don't need the money, and then just keep the rent. You may be bringing in $30,000 a month for all by then, right?
Yeah.
Or you can write, go get a new loan and cash out and buy a ranch. Who knows?
Yeah. That would be what I would want to do. Yeah, I love it. Yeah, this is kind of a trick question, but maybe not, especially not for you. Like, how many properties does it really take to be a real estate millionaire? And then I was like, in most markets, you can do it in like 2 or 3. But 5 everywhere will do it. You just have to let your tenants pay off the mortgage. You know, $200 a month, $100 a month, even $500 a month. You know, you're not going to retire off of that, but you will retire off of the mortgage paid off. You got a few of these. Now you got $1 million plus, in addition to whatever else you have in your 401k, Roth, and all this other stuff.
Yep.
So,
sitting there watching all of my tech stocks go up and down and up and down and up and down. It's crazy.
yeah, and probably your Bitcoin. I don't know if you're in crypto, but
yeah, Bitcoin's doing all right. I have more Ethereum than Bitcoin. It's doing better.
Yeah, I really like ETH. So real estate market, back to that in 2022 for investors who are looking to get in. You know, there has been that. Well, we talked on the you know, the whole, hey, I should wait. So let's go a different direction. There are those who they're getting frustrated because of the unique circumstances of this market. It's highly competitive due to low supply. What advice do you have for those investors that do want to get in? They don't believe the market's going to crash tomorrow. They're just getting a little frustrated.
Yeah, and you got to remember, you know, 20 some odd years ago when we started buying houses, there was no competition. So we could buy, you know, 20 houses a month easily. I say easily. It's a lot of work, right? But we could source 20 deals a month without a whole heck of a lot of advertising or effort. Nowadays, it's not a thing. It's highly competitive, very sophisticated players out there. You know, you've even got private equity competing and overpaying, which is fine if they'll fail. So, but what you can do and do very successfully, and we've done this 50 times in the last few years, just buy from wholesalers. I mean, there's still some meat on the bone. You don't have to steal a house to rent it out and make decent money, and in the long run build a whole heck of a lot of wealth and not have to build this whole advertising and buying machine, right? You don't need all that infrastructure if you just pay the wholesaler a couple bucks to find the deals, let them make a couple bucks. You may pay a little bit more than you would have, but heck, by the time you figure out all your overhead for having a buying machine, it might not be that far off.
Yeah, at the end of the day, the wholesaler, you're outsourcing operations, specifically marketing and sales. Like, do you want to go out? And if you have a full-time job, it's going to be very difficult in this market. I mean, it's difficult in general. In this market, it's going to be extra difficult. So you're saying, hey, go out and find those really reputable wholesalers in your market and get to know them, get on their list, talk to them. And that's just a good way to do it without having to do all the monkey business.
Honestly, if you perform for a wholesaler a couple of times, they'll put you at the top of the list. I mean, they are very short-sighted. Yeah, they're very short-sighted a lot of times, where they'll take less from a sure deal than try to put it out and get more because they're not sure that deal is going to happen. And, you know, I say short-sighted, and it also may be just a little risk averse because maybe they've got a contract that if they don't close, they may lose that deal, where they're going to go for the sure $5,000 than try to make 15 and not get anything.
Absolutely. And I guess word of caution for the investors wanting to work with wholesalers: vet the wholesaler too. Like they're definitely going to vet you, but you need to vet them too. Get references. Don't just go handing out cash to people you don't know.
Yeah, I've always loved the whole $3,000 non-refundable thing. And I tell them, well, yeah, I'm not doing that. So
yeah,
if you want to make a deal, we can. I'll put some money at the title company, but I'm not handing you $3,000, and I don't even know if you have clear title.
Yeah,
I've never understood that whole model. Now, there's a guy I've done 30 deals with, whatever, but for the most part, it's going to the title company to earn his money.
Yeah, absolutely.
None of this non-refundable. I promise if we don't get clear title, I'll just give it back.
Yeah, yeah. And with those contracts that have automatic extensions in perpetuity. All right. How can folks reach out to you?
Rich at renterswarehouse.com. We're at renterswarehouse.com. Check us out on the web. We got plenty of data there to check out. One of the things we do that I think is pretty cool is we can analyze rental property for you. We have a marketplace. So if you go to investor resources or investor marketplace on our website, we have portfolios for sale. We can help you sell portfolios. We can help you buy portfolios, but it's a pretty neat little deal where you can kind of, it's industrial level analytics for free. I mean, you can go in there and look at yield over time. You can look at all you can put in all the variables you want and analyze a property there all for free.
Wow.
When I recommend property management companies, just tell them, like, look, they're going to be able to let you know all the stuff that you don't know about rent rates and good areas and all this stuff. Like, that's where your property management company comes in place. And
and honestly, our agents, we have realtors working for us, and they've been trained to be kind of, investor friendly, right? So they're not your typical, no offense to a Keller Williams or whoever, but those realtors want to talk to a mom and pop that have a $800,000 house for sale and they want to be the listing agent. They don't know what cash on cash return is. They don't understand, capital reserves for rentals or maintenance reserves. They don't understand how much it's going to be. Ours talk that language, and they can really look at it and say, well, this looks like a great deal. And they go, don't forget, look at the HOA on this house is $800 a year. The tax rate, it's a mud, it's too high. And you got to put some money aside for the AC and the roof, because the roof's 8 years old and the AC is 12 years old, right? So our guys will talk you out of a deal if that's the right thing to do, right?
Yeah.
So
that's a great tool to have, because that's really the number one question we get. Like, how do you analyze if this is a good rental or not? And that's an awesome tool that y'all provide.
Go ahead, Jamie. Sorry.
Oh, it's done.
No, you also have to look at like I said, tax rate. You got to look at, is it Galveston County? Is it windstorm area? Or now you got extra insurance?
Yeah.
Or do you have flood insurance? Right. So all those things add up to an effect on your yield. And our realtors know how to look at that versus the realtor that knows, well, that's a, so-and-so backsplash. And this is a so-and-so, this is a Thermador refrigerator. Don't you love it? Where you want to sign now? That's all they know. Right.
Right. Yeah. Well, yeah, that is a great tool to have. And everything you said, a lot of the things you stated really resonated with Chris and I, especially the part about hold more properties. So if you're listening and you're getting anything out of this today, hold more properties, because that is one thing. Shoulda, coulda, woulda, wish we did. We're doing it now, with all those flips that we've done. Man. So thank you so much for joining us. It was great having you on. All right. So now we're back on schedule. Next, let's bring on Crystal Shayu. Said it right, correctly?
Yeah, good job. That's a rarity.
Well, I asked before, so I did my homework. But welcome. Thank you so much for joining us this morning. A little bit about Crystal. Crystal is a real estate investor and team leader of the Investors Gone Wild team at eXp Realty. In 2021, she sold $22 million and signed 200 short-term rentals with two of the top leading U.S. vacation rental companies. So we are so excited to have you on and can't wait to hear from you.
Glad to be here.
Hey, Crystal, how you doing?
That's great.
Glad to finally talk to you. You got a very, very robust team, and also investor focused. So I was like, hey, you'll be perfect for this show. So how are you seeing 2020 shape out for real estate? What's going to happen?
2022 next year.
Yeah, did I say 2021?
You said 2020. You're a little behind the times.
Oh, 2020. What's going on here? Yeah, no, 2022.
Yeah,
no one wants to go back to 2020.
No, let's not do that.
Year.
Yeah, that was a little more challenging. Well, this year's been a lot busier, that's for sure. But going into 2022, at least in our market down in Panama City Beach, Florida, we are gearing up for another really insanely busy year because all indicators are our inventory is still at like 1,200 available units listed in MLS, where I was at 2,200 when I started. So we're under half of what we normally have. And as you hit 1031 season and all the new tax money gets here, we get very, very busy we're very seasonal in January, mid-January to June was our busiest time. As everybody spending those tax dollars. So we're gearing up for a lot of activity. What's also happening down here is Jacksonville, Tampa, and Orlando are the three fastest growing markets in Florida, and the Villages outgrew all of them. That's a 55 plus retirement community. And they have just started a ground up here off of Highway 79 for a Margaritaville themed retirement community. So we've got a lot of infrastructure changes with the biggest developer from 30A moving over here. So the whole culture shift here is looking like it'll be a very good, positive outlook in real estate this year.
How is that impacting short-term rentals? Because that's been a very, I personally believe it's a young market that has been growing just rapidly. More and more operators are coming on board. COVID made it very convenient to or desirable to experience short-term rentals if you've never done it before. So how is that going to shape out?
Well, and to your point on COVID affecting it, that was one of the things that I was going to mention as to how it's transitioned so many more buyers into our market. What we saw in the very heavily shut down states like California, Illinois, and New York, we had a massive influx of investors coming from those markets because our governor's very pro open business, and so we had a lot of activity out of those states. And just in general, people can work from home and restructure their lives. And we're seeing a lot of that. And where better to do that than at our beautiful beaches? So we're seeing a massive shift in just how everyone works because of all that. So I think that's one of the reasons our market's growing so fast. Plus, just the difference between the South Florida culture is a little more high-paced, more urbanized. It's still more rural here. A lot of people like that down home. They call us the redneck Riviera here. So it's a little more retro. So we're seeing a lot of growth up here for sure.
Are you seeing? So short-term rentals has impacted prices because now certain communities, certain markets, there's a whole new exit strategy to it that never existed before. They're too expensive to rent long term, but hey, now that we have a platform to very easily rent short term, that's a whole new buyer pool that otherwise wouldn't be there. I mean, at that point, the only other people that want it are secondary homes or primary retirement type homes. So are you going to do you expect that to continue into 22 as hot as it was? And because 2021, that was, I think, a lot more people were starting to realize that.
Yes.
You see that continuing?
I do. It depends on the regulatory changes. The 30A market in Destin, they just proposed some new legislations that will really impact short-term rentals if it's passed, because they're proposing restriction by number of cars on the property. So that'll be some massive restrictions, and that'll really upset the apple cart there. Panama City Beach is very pro travel, very pro industry. We have about 6 million visitors a year. So especially on the east and west ends of our beaches, they're county regulated and there's not much restriction in that space. In the city, it's like a drunk person drew a line on what's allowed or not. So in this in the city locations, it's more, there could be more legislation changes that would cause more of that. I know I personally bought in a short-term allowed neighborhood. It's 3 blocks off the beach. It should be. And I'm just selling out of that property right now and then flipping into something on the water that is short-term allowed. So I know my property values were impacted at least 80 to 100,000 is what we see as a difference in short-term allowed or not in our market.
Yeah, that's a huge difference. We bought in one that it was allowed, but once they found out that it was allowed, they very quickly solved that and then sued us. So that wasn't fun, but we have another one like a few miles away. It was frustrating because it was an amazing lakefront property.
It is very frustrating because our MLS board did not even put that as an option to check the checkbox short-term allowed or not until about 8 months ago. There's still so much lack of knowledge among most of the realtor base here, because I sold one this year. It said short-term allowed, and when we called the city to verify it, it's not. And my clients had bought it as a short. And so the realtor, even the real estate based here, they're not as educated on that. I worked on the property management side for 3 years. After I bought my first condo, I hired the largest property management company in the U.S. to manage mine. And so but I went to work for them in sales. And so I got to learn a lot about the zoning restrictions very quickly. Yeah. So it's either from a city level or an HOA level, but it impacts it either way for sure.
Absolutely. 100%. And that's why it's important to not go into these, especially if short-term rental, because that is very regulation unique. Work with an agent and a team that knows what they're doing, has experience in that. So for let's talk buyers. So you work with investor buyers, because you're an
Primary.
invested agent at our brand here. So you work with other investors, they're buyers. You help them get into deals. It's been a little frustrating.
Yeah.
I mean, do you expect that? And frustrating is an accurate word. I'm just trying to think of another way to do it. What are you doing to help those buyers meet their investment goals in this short inventory market?
Well, it's really knowing how to comp like a champ. That's a lot of it. A lot like, and he mentioned wholesalers. Even some of our wholesalers, I've been able to pick up some really good deals because they don't know how to run accurate ARV. Being on the listing side a lot as well, because I've done about equal on both sides of the transactions. I know how to look at that ARV, and then we do a lot of educating with clients on how to bring it to its highest and best value. What we see in this market in particular is a very low inventory of rental ready homes. There's a lot of repairs needed in a lot of ours, but it's very challenging on the labor side. So I personally run rehab crews all year because we couldn't find a way to get these homes purchased otherwise. So we've come up with some very creative solutions for our investors to get them in, some very good deals on properties that can't sell at top value, or the ones that are selling at top value. When I call them with that deal, I mentally prep them beforehand. When I call you, you need to be ready to buy. So we get everything ready on the front end so that when that deal does come, because I've sold so many this year, I've run over within hours of it listing on the MLS and we lock it down. And so because and a lot of the realtors who are not really investors, they don't know how to price. I sold one as a long-term portfolio. He had a great long-term portfolio in Texas. This was their first short-term rental. It was brand new construction, just a few blocks off the beach. It listed at $250 a square foot, where I was selling used inventory at $280 a square foot. So I knew that was too low.
Yeah.
I beat out 12 offers to get it for them. They're thrilled with it, and they already have instant equity in the home. So it really is just connecting with the right agent who knows how to negotiate, because there's deals in any market, in any situation.
Yeah. And if you can, because it's an equity game, like holding properties is an equity game. As long as you can wait it out. Now you have to, there's real money involved and there's cash flow situations. So you have to make a smart decision. But if you can make the numbers work, even if it does take a little bit more out of your pocket to get the deal done, you're probably going to be able to pull that out in 3 to 5 years. Probably. Right. Of course, there's no way to guarantee that. You never know what can happen. But the way things are going, the way things look, 3 to 5 years, there's a high probability that you'll be able to take it out, get that money back, put it wherever else you need. So I just tell people, just control the asset. That's all you want to do. And heck, you can even bring partners. And
absolutely,
if it's going to cost you $30,000 to get into a deal and you only have 10, and you definitely don't want to spend all 10, there's a lot of people that have the extra 20, 25, 30 or whatever that you can bring in that'll help you, because they want deals too. They just they don't have the deal. You get the deal, they get the money, make a deal together.
Right. And that's how I have a new business partner. We're launching a vacational company ourselves. And that's how that I worked with him. He was looking to grow a short-term rental portfolio. He needed a nanny to help and a cleaner, and he needed a handyman. And so every point along the way, whatever he was looking to solve, I solved all those problems. And now we're partnering together because and I've handed him several of my personal deals this year that I would have put under contract. And they're very, very solid deals. Like the one we're under contract on 2 side by side. Mine's 60,000. I got the appraisal in yesterday at 60,000 under market value. His is going to come in about 125 under market. So it's there's still, you just have to know how to look for it, and a lot of it's a waiting game. I do have quite a few clients that work with some wholesalers, but I have found some really great deals on MLS when you wait until they're aged inventory and then you negotiate really well. I'm finding a lot of great stuff that way. You have to wait it out.
Yeah. Awesome. Well, it's been a pleasure. Look forward to working with you more in the future here. So how can folks reach out to you?
They can email me at crystal.shailou, CHAILLOU @exprealty.com. And we will have a new website up and running Q1.
Look forward to it. Thanks again.
Thank you so much. Great hearing from you.
Thanks.
Okay, why don't you introduce our next guest? Oops, I got him. Go ahead, Chris.
How's it going, Yona?
There we go. How you doing?
Doing
Hi,
good. Doing
Yona.
good.
Thank you so much for joining us. A little bit about Yona. Yona is a business director and cost segregation expert at Madison Specs. He has assisted clients in saving tens of millions of dollars on taxes through cost segregation. Yona also is a real estate investor and host of the popular podcast, Wise Advice. Thank you for
How you doing?
joining us.
There you go. Yeah, thanks for that intro. How you doing?
Absolutely good. Glad to have you. So I've followed you, and I've seen you all over social, which is good because that's what you're doing, right?
That's it means it's
And then-
working.
Yeah, that means it's working. And then I saw you in I think it was Orlando a few months ago, and I mean you're easy to pick out of a crowd. I was like, hey, I know that guy. I gotta go say hi. So I was glad we were able to connect, and then now connect on here. So topic of the hour has been real estate in 2022. What can we expect the real estate market to look like as we get into next year?
You know, it's been so unpredictable over the past 2 years, ever since the differences and what's happened with COVID, the lockdowns and everything like that, and now different states are talking about different lockdowns and things like that. So it's very difficult. Obviously, I'm not a psychic or a prophet, but I would venture to say that things are going to just continue the way that they have gone. And what we've seen is that at the very beginning of COVID, there was a lot of trepidation, and people, just because of people didn't know, right? I think the majority of the world, or at least the United States, especially the real estate market, has gotten used to the unknown. So people have gotten used to working from home. People have gotten used to doing, Zoom calls and everything. And obviously, it was great to meet in person. It's great to go to these networking events and things like that back in person. But I think technology has really accelerated the game in many aspects, especially with doing things remotely. So I think we're going to see a lot more kind of tech oriented integrations into real estate investing, I think, in the coming year.
Yeah, I think it fast forwarded the timeline. I forget who said this. It was like 15 years. It was such. I mean, this show was birthed out of that. This show was actually a local event. It looked much different because we actually tried to bring the event online, and it was like, okay, it doesn't really work the same way, so we changed it to more of a radio podcast type show. But yeah, everything has changed. I mean, we're getting real estate agents actually having virtual showings and even doing virtual signings. Virtual closings, and that's actually a topic to where having digital and type virtual actual closings with certain title companies, that is very new, but it's happening. Now we're talking about metaverse, and I'm like, well, and then we got eXp Realty's got eXp World, this whole virtual campus for their entire company, and other company like COVID, and so other companies are doing that kind of thing. Change has definitely been very common.
Yeah.
So, you're tax expert. Would you consider yourself a tax expert? I know you're definitely an expert on cost segregation.
So cost segregation is really the main thing that I focus on. That's what our company does. We're actually not an accounting firm. So I wouldn't consider myself a tax expert, but within real estate taxes, I have a pretty good grasp on it, and the specifics surrounding cost segregation, I probably know more about than 99% of CPAs out there. So
yeah,
there, those specifics.
That's really in relation to at least passive losses, depreciation, and cost segregation, which is depreciation on steroids. I guess give a 10, 15 second summary of what that is, because that'll set up my next question.
Sure. Depreciation is a tax deduction that you get when you buy a property, anything besides your personal residence, investment, or business property. It takes the purchase price and basically divides it up over a very long period of time, that you get to take this income tax deduction. What cost segregation does is it accelerates some of those deductions from that pool of potential deductions you could take over a 39 or 27.5 year period, and front loads a whole chunk of them into the first year or into the first several years. And so it's a strategy to use those potential income tax deductions now when you can use them and need them most.
So how that sets up the question, we've seen a lot. I mean, real estate's been hot. The investor side of real estate is growing and growing and growing. And that is, unfortunately, the negative part of that causes extra problems for affordability for actually owner occupant properties. But it is what it is. Investors are moving in, and a lot of them are moving in because they have W-2 incomes, but they need to invest. They're not really sure if they want to go into buying index funds at the record prices they're at now, and they want real estate. But one of the biggest benefits for those types of investors is depreciation. What have you seen over the last 18 months with real estate and those type of investors? I'm gonna classify them. They're passive. They're passive investors. They're not folks maybe like us that are in the game. Have you seen an uptick in those passive investors, whether it's through a syndication or just an individual passive acquisition, acquiring properties? Or have you seen an uptick in that? And do you see any changes going into 22?
Sure. There's certainly been an uptick. When there's more knowledge out there, especially, in the past few years, real estate and syndications, and it has become a lot more public knowledge, these forefronts. So there is getting a lot more information about there on many different levels. So for example, even Grant Cardone, just putting it out there to people, and then, those people might not work with him, but they're going to be doing their own research. You have a platform like Bigger Pockets that I remember, 3-4 years ago, where there's maybe, like 600,000 members. It was like this huge community, and now there's like close to 3 million members of Bigger Pockets. Things like that. It has grown. So there's definitely a lot more knowledge out there, which has introduced this to a much broader base of investors. They are coming in and using this type of investment to get this, as you mentioned, the tax benefit depreciation, which really benefits them in the investment itself. And so it is a tax friendly sort of investment. However, it not necessarily going to benefit them for, to help offset their W-2 income. That's something that I think is a lot of misnomer. People think that, you can use these.
Because of the real estate professional designation.
Correct. Yeah. I mean, there are certain kind of loopholes and certain different ways to get around that. But by and large, the main benefit is that, here you have this investment. And guess what? If you're doing, and these sponsors doing a cost segregation using that bonus depreciation, then you essentially are going to get these returns during the hold period of that property, going to be completely tax free. So that's a benefit that I think a lot of people hadn't seen with other types of investments.
Which that tax-free return that you're getting ends up, if you're doing it right, compounding your rate of return, because if you're able to roll those off and reinvest those into other assets, time value of money, accelerated, that's the game.
That's what it's all about.
The wealthy play,
That's
right?
the name of the game. Exactly. That's what it's all about.
All right. Any final thoughts on what you're anticipating in 2022?
I don't even know. That's the funny thing, right? 2021 was a crazy year. I didn't anticipate what happened this year, and I think no one really did, in terms of, the market just keeps getting crazier. You have tertiary markets getting much more attention. Different asset classes like self-storage and mobile home parks are getting, single families, Airbnbs, getting a lot more attention by a lot more people. And, I'm just excited to see what's going to shift and what's going to transition to 2022. It's certainly going to be something. You're not going to see, you are going to say, I'd rather put it in the positive. You are definitely going to see new things and new asset classes or new things, whether it might be industrial, taking a big, rocket fuel to it. Who knows? But I'm definitely looking forward to see what that's going to be.
Yeah, well, for me, one thing that's been interesting to watch is how office space is going to play out. And I think that, at least from what I've read, it's still more of a longer timeline. We don't necessarily know, because retail was a big question, but it's actually done okay. You mentioned industrial and warehouse space, which has just been going crazy. And then, multifamily has been nuts. So, all right. How can folks reach out to you?
Best way to find me is on LinkedIn. I'm extremely active on that platform. So if you are watching this and you have a LinkedIn account, definitely reach out, send me a message there, or you can go to yonaweiss.com. Just my name, just spell it out, .com.
Thank you very much, Yona. Look forward to connecting with you at another event soon. And thanks again.
Thanks
Pleasure.
for joining us.
Thank you, guys. Have a great day.
Bye.
All right. This was a crazy episode.
Did it freeze? It froze on mine. Did it freeze? Okay. It froze on mine.
We're live. We're live. So we have the summit coming up January 13th. So roughly a little more than 4 weeks away. You can go to investedagents.com/summit. Investedagents.com/summit. Free RSVP. We have a book coming out that should be published by Christmas Day. I know we've had some publishing delays, but should be ready to go.
Yes.
But if you RSVP for the summit, we'll make sure you get a free copy of the book. And the summit, if you attended January of this year, it's an all-day virtual summit and just jam-packed with multiple speakers giving high-value content. We got folks talking about self-storage and Airbnb and short-term rentals and large multifamily and flipping and marketing.
Yes.
And
It's like all the things in real estate investing. So we try to touch on each and every topic and get the best speakers out there. And it was so much fun earlier this year. So we are looking forward to another Invested Agent Summit.
so be sure to RSVP and we'll see you next month.
Yes,
Have
thank
a
you for
great
joining
Christmas and
us.
New Year.